Hello, everyone. We'll be getting started here in about 30 seconds. My name is Ryan Allis. I'm the CEO and co-founder of SaaSRise. And today we've got a webinar on the topic of how to raise revenue-based financing for software as a service companies. I'll start the recording here. All right, welcome everyone. Ryan Allis here with SaaSRise, the community for software as a service CEOs and founders. We are here today with Keith Harrington, the co-founder and COO of Novel, and Nathan Latka, the CEO and founder of FounderPath. How are you guys doing today?
Feeling good, Ryan. Thanks for having me.
Yeah, doing great. Thanks a lot for having us.
Well, hello from Austin, Texas. Good to have you guys here. I'm also here with my colleague Salman Hatta, who is Vice President of Member Success here at SaaSRise. And we are going to be talking about a topic that all of us are pretty passionate about, which is how to scale a company without getting diluted, how to scale up customer acquisition, and how to have capital to invest in research and development without necessarily selling our soul to venture capitalists and giving up lots and lots of equity dilution. So it's a topic that I'm passionate about. I'll just share my experience for a minute, and then we'll turn it over to these guys to share their experience running two of the larger revenue-based financing companies out there. And then we'll take some questions. Feel free to, as an attendee, post any questions in the chat window, or if you want to do it anonymously in the Q&A window at any point throughout the webinar today. And we'll cover those questions in the last 20 minutes or so of today's webinar. I'll share my background with raising venture capital and my background with raising revenue-based financing, and I'll tell you why I've actually enjoyed being a bootstrapper this time around. I spent 10 years building a software company called iContact in the email marketing software sector in North Carolina. We grew that from 0 to 50 million in ARR, and we sold it in 2012 for $169 million. We had a great exit. We raised 3 rounds of venture capital. We bootstrapped for the first 3 years to $1.5 million in revenue. And then we raised 3 rounds of venture capital after we'd already gotten product market fit. We raised 500K in round 1, 7 million in round 2, and 40 million in round 3. And when that works, it works and everyone does well. But frankly, venture capital is only appropriate for maybe 5% of companies at most. And there are alternatives today that simply didn't exist when we were building iContact. And it allows bootstrappers like myself now building SaaSRise to thrive, succeed, and have the capital that we need to grow. What we did at SaaSRise, I'll just tell you what we did instead of raising equity capital. We simply got a revenue-based financing. It's effectively a loan that we are now paying back over 2 years as a small percentage of our revenue. We took $170,000 revenue-based financing, effectively a loan, in May of 2024. And we did that through FounderPath. Nathan, thank you for that. He's on the call today representing FounderPath. And that helped us invest more in sales and marketing and customer acquisition, which has allowed us to go from 1 million in ARR a year ago when we took that to now 4 million in ARR in February of 2025. And so it was super helpful to us because we had positive unit economics. We knew how much a customer is worth. We said, if we put more money in the top of the funnel in the machine, we'll have a more valuable company. So that's my experience with revenue-based financing. I'm going to share some slides here, and then we'll get these guys introduced. So here we go. Let's jump in here. And if you're not already part of SaaSRise and you're watching the recording of this later, check us out at SaaSRise.com. And for our members live on the call today, we're super excited to have you here. I've already shared my background, so I don't need to go too much into this slide. But whether you're a venture-backed company or a bootstrap company, we're excited to have you here and part of the SaaSRise community. Our 2 panelists today, I'm going to have them introduce themselves here along with the slide that we have for them. So Nathan, if you want to start first and maybe take 2 or 3 minutes and share your background, what you do and sort of what you're focused on at FounderPath. Nathan, you're still on mute. Nathan, you're on mute, so I'm going to go here first.
Is this better?
Yeah, go ahead, Nathan. Go for it.
I was making fun of myself while I was still on mute, saying that was such a junior mistake. But glad you guys can hear me now. Well, I was joking here about how young I look in this picture. But Ryan, like this is where our history started. It's where FounderPath started. But I dropped out of architecture and launched my own software company back in 2009. This is an embarrassing photo, but like Ryan, I don't know about you as you were building in the Research Triangle in North Carolina, but everyone would tell me, well, Nathan, how big is your team? That seemed to be like the estimate of like if we were doing well. So I said, screw it, I'll just go hire 20, 30 people. So that's what we did, as you see here on my screen. And then people said, well, how much equity have you raised? And I said, okay, fine, I guess I got to go raise equity now. So we did 2 million there on an 8.5 pre with David and Code at Techstars. But guys, like this was my cap table. I mean, like Ryan, you see this one right here?
Yep. Adult supervision CEO.
David, bless his heart, at Techstar said, Nathan, like you're so young. He said, I'm never going to travel to Blacksburg. You need to put in an adult supervision COO. Well, guess what? That came with another 9% dilution. So like at this point, I only owned 38% of Heyo. And this is actually where Ryan and I's paths crossed early on. This was a acquisition offer that we got from none other than the guy that is now building one of the most successful, if not the most successful, software community on the internet at SaaSRise. Ryan, this was back in, Ryan, I think this was back in I want to say 2011 maybe, right?
Yep. We almost bought your company back then.
2011. And so, my whole team went up to Ryan at the Research Triangle. His team grilled me on things like ARPU, LTV, CAC. This ultimately ended up being where we were, $6.5 million acquisition price. We had bootstrapped to $1 million at this time. But one, Ryan's team was going through an acquisition, or Ryan, I don't know the timing, but I know on our side, my board was basically like, well, Nathan, we just put money in at 10.5 post. Like, why would you want to exit for 6.5? And this was the moment I realized, like, holy crap, like, why do people raise VC, or at least a lot of VC, right? You can raise maybe less than 1x ARR, but you really start to lose up a lot of your optionality if you go much bigger than that. And so that's why I then sold that business to a company called Vodago for much less than what Ryan offered, by the way. It was a flash sale, didn't make a lot of money, and then launched this podcast where I just said, I'm going to learn. And on the podcast, I've interviewed 3,000 SaaS founders, one per day since 2015. You guys might recognize some of them on the screen here: Henry at ZoomInfo, so Wade at Zapier up here, Sid at GitLab, etc. And Ryan, it was around 2018 when a bunch of these smaller software founders said, Nathan, I don't want to give up equity. Can you help me raise debt? And I had no idea what it was, but I learned and launched my own fund. I got paid a lot of money to get deal flow out to other providers. I learned, I basically took things that I liked from their term sheets and then also eliminated things that I didn't like from their term sheets, launched our own fund, and then closed a larger fund in 2022 for about $150 million. So that's the FounderPath story in under 4 minutes.
Well, fantastic. I'm super excited to have you here today. And now I'm going to go over to Keith, and I'll pull up a slide for you for your bio. Would you introduce yourself and tell us how you ended up working with Novel?
Yeah. First of all, Nathan, that was awesome. I love your story. And I see that so often with folks who are building something in the alternative capital space. I actually came from the other side of the table. I was directly before Novel, I was a VC. I'm sad to report. So I was making investments in companies that would have outcomes like what Nathan described, and like what Ryan described. But what I found myself doing most of the time was talking to entrepreneurs who I really wanted to help, but I didn't have the right kind of tools in my capital toolbox, right? I would talk to a company or a CEO with $1 million in revenue or $2 million in revenue, 30-40% growth, and they'd be out raising equity because that's what everybody's taught to do. And I would have to say no. And like Ryan said earlier, less than 5%, I would argue that it's really like 1/4 of 1% of companies do and should take venture capital as their funding source. It just got to the point where frankly, I was frustrated. I would talk to a CEO, I would really want to help, but I didn't know a bank that could help a software company with capital. I knew that VCs weren't going to fund them if I couldn't do it. They weren't going to do it, and they probably would stop taking my calls if I kept sending them deals that I knew I couldn't fund. So I just got to the point where I wanted to try something different. So I started researching different ways to help SaaS and other CEOs. actually capitalize their businesses in a way that wasn't dilutive, in a way that didn't lead them to take wild shots in the dark at valuation, and in a way that would actually help their companies grow. And so I found the concept of revenue-based financing, like just exactly like Nathan. I stole a bunch of term sheets. And then I took the stuff that I liked, got rid of the stuff that I didn't like. We
Hey,
built
come
a
on,
fund.
steal's an aggressive term. Steal's an
That's,
aggressive term.
but I say it with great respect. And we built our first fund. It was a very small fund back in 2018. It was called Novel Growth Partners. And then once we kind of understood that this was something that entrepreneurs really needed and that we could actually help with, we went out and started building a company that would actually do this in a more automated way. Raised a $100 million debt facility, another $20 million to lend, and we've been helping entrepreneurs ever since.
Well, thank you, Keith, for existing in the world and for helping popularize this new model of financing that doesn't create a whole bunch of stress and anxiety that can come
Yeah,
the venture world. I think many venture-backed founders have been through that venture stress spiral. So thank you for providing alternatives. So now what we want to do is go through a few slides to explain how revenue-based financing works. And I'm just going to ask, here we go. We're going to get this going here. I'm going to share my screen. I'm going to present for maybe 5 to 7 minutes, and then we'll go through some questions for the panelists, and then feel free to put some questions in the chat window. So topics we'll cover today: what is RBF, how to use debt to fuel your revenue growth, how to compare it to venture funding. We'll tell the story of how we took a RBF financing last year and what happened after, and how easy it was. We got approved in 72 hours. We had the money wired we applied on a Monday, got the money on a Friday. We're going to see what lenders look for when evaluating recurring revenue businesses, SaaS businesses, for financing, how to prepare in advance, important terms to consider, effective interest rates, what's going on in the market right now for that, common pitfalls to avoid, and examples of companies that have used. So we'll talk about all these topics in the next 45 minutes. First, though, I want to just set the basics. So what is RBF? So revenue-based financing allows recurring revenue companies like software as a service firms to get capital they need to invest in areas like sales and marketing and R&D. And oftentimes, RBF firms like the two that we have with us today will usually offer around a maximum of 50% of your current ARR. So if you're at 5 million in ARR, you could potentially be approved for a $2.5 million revenue-based financing. And someone asked earlier, is this like Stripe Capital? It's sort of like Stripe Capital, but it's much longer terms. You know, we've taken a Stripe Capital loan as well, and you got to pay that back in like 4 to 6 months, maybe 8 months at most. Here, you could get more flexible terms, 24 to 48 months from your future revenue, which is really nice. If your revenue goes up, you pay it back faster. If your revenue goes down, you pay it back a little bit slower over time. There's some major players in the field here. We've got FounderPath and Novel represented today. There's obviously quite a few out there. We'll share the link to this slide deck so you can access it. And we'll send the link in the recording around to everybody that participates in it. And so when do you want to take RBF? Well, you want to take RBF when you've already got some revenue and you want to accelerate growth by investing in the things that drive growth. Well, what drives growth? Either sales and marketing or your product, R&D. And so if you have a opportunity where you know your unit economics, you know your ARPA, you know your LTV, you know how much it costs to get a customer and how much that customer's worth, well, then you might want to consider accelerating that. So what is a good payback window? I write a lot about this, but anywhere from 6 to 12 months of upfront revenue is what you might be spending on sales and marketing. If you get a payback in that 6 to 12 month range as a software as a service recurring revenue company, you might want to invest more. And so if you're basically trading maybe $5,000 in CAC to get $50,000 in LTV, 10 to 1 LTV to CAC ratio, well, then you should probably ramp that up. If you're getting your money back in 6, 7, 9, 12 months even, you might want to ramp that up. And so there's a case study here that I wrote last year. It's the case study of when we actually did a $170,000 loan through FounderPath. You can see the actual email I got here from underwriting. We applied on a Monday. The actual wire came in on a Thursday, 4 days later. So we'll put the link to that in the chat window here, and check out this case study that we did. It was something that was very successful for us. So simple flow chart here. Do you have at least 50,000 in ARR? If so, then if you know your LTV to CAC ratio, you've done the work to calculate and figured out, if I put X dollars into sales and marketing or X dollars into future product development, how much is that going to likely increase my revenue by? Well, then you should consider taking on capital. If you've calculated your LTV to CAC ratio and it's at least 6 or 1 or higher, you should consider taking on some capital. If you know how to use it, you want to be able to know that that input is going to create a better output. So this was the timeline that I've already showed. We took the money from Nathan from FounderPath. They had a very nice interface and backend. They had sort of created a Bear Metrics or Chart Mogul-like analytics platform. This is our actual MRR at our company, SaaSRise, as of yesterday when they put this in there. So you can see we're just a little bit over 4 million ARR.
Ryan, we have to celebrate this. I don't mean to cut you off on your flow, but this is like crazy growth. I mean, we see companies like this all the time, and I look at these charts all day long across dozens of companies. You're like just doing something incredible at SaaSRise. I mean, the content you put out obviously is incredible, but this actually converting the content you do into this kind of revenue growth is just absolutely incredible. So just kudos, man. This is awesome to look at.
This is incredible.
Well, I appreciate that very much. And we're experienced operators. We're a lean team of 5 people, and the whole thing is about building community. And if you build community and help them grow, it turns into a great company. So thank you for that encouragement. And we'll certainly have lots of content out there on sales and marketing and how we did this. But the basics in 10 seconds was we did a whole bunch of quality content like this. And then we built an ABM lead list of everyone in our target market, every SaaS CEO and founder in the world. You can do the same thing, like I wrote yesterday in my article on Clay or Instantly or Apollo or ListKit. And then once you have the list of everyone you want to target in your ICP, then you start sending content, doing outbound, doing retargeting ads, doing matched audience ads. That's what we do. And it's worked very, very well for us. And then you can see the big jump in October. That's when we launched our B2B SaaS growth program, which is a big part of our revenue now. So thank you to FounderPath for having great analytics. I encourage everyone to set up a free account on FounderPath and just check out your own analytics. It's sort of like, better than Stripes. I would say it's getting to be as good as Chart Moguls or Bear Metrics or SaaSgrid or ProfitWell. So this is the actual email we got last April from the team at FounderPath saying, "Here's your money." Got the money a few days later, it was basically just upload your chart, sync with your bank account, sync with your Stripe, upload your articles of incorporation, and boom, there's your money a few days later. So it worked out pretty well. And then this is Novel's Capital platform here, which Keith, I'm sure you'll talk about in a few minutes here, which is, obviously very, very beautiful as well. So it's not just, you can't just compete on capital terms alone. You need to compete on capital terms plus, market analysis and as well as introductions. So we'll talk about that in a few minutes. So some of the terms that you want to look at is term length, like 6 months to 48 months. I've got this Stripe Capital loan right now, which is great, but it's 4 months. I got to pay back 30% of my revenue for 4 months, which is a lot. It's, when you do an RBF loan over a 2 or 4 year period, maybe you're only paying back 3, 7, maybe 10% of your monthly revenue, depending on how much capital, of course, you took. So think about the length. Go ahead if you feel free to make a comment on that, Keith.
Ryan, yeah, I don't mean to, I'm sorry to interrupt, but did you say 30% of your revenue?
Yeah, I took a 4-month loan, and we're paying 30% of our revenue, but we got a significant cash advance from Stripe Capital in November in order to do that.
Yeah.
And we just did that because we're about to launch new communities.
Gotcha. Okay.
Yeah, but I need to talk to you guys next time I do that. Interest rate, we'll talk more about that in a little bit. And you want to look at that. You want to look at the deferral of the principal. Can the loan be interest only? Sometimes you can find companies that will do that depending on the size. Do you need to give out warrants or equity or options? By default, usually not, but sometimes it could be part of venture debt. what the firm requires you to do to stay out of default. What are the covenants? Usually warrants and covenants aren't going to come into play unless you're doing a much bigger loan. Any restrictions on the actual proceeds, any personal guarantee, not usually required in revenue-based financing, which is fantastic. And then can you pay off early, and do you have the ability to refinance? So these are just some terms. So I wanted to give that 10-minute quick overview. Check out these slides. Salman, if you can put a link to both that case study we mentioned as well as this slide deck on revenue-based financing into the chat window, that would be great for everyone. So we'll give you some more slides here. So now I want to go back to sort of the questions we want to cover today and open it up to you guys, Keith and Nathan. And I just, I want to know where are these questions that we want to cover? I want to know what advice you guys have. What advice do you guys, I'll start with this, and I'll start with Keith, and then I'll go to Nathan. What advice do you have, Keith, for companies that are, let's just say between 50K ARR and 50 million ARR? What advice do you have for growing recurring revenue companies that need non-dilutive capital?
Yeah, it's a great question, and it seems like a really simple one, but it's super complicated, right? At the end of the day, each business, depending on where it is in its journey, needs to evaluate very carefully what kind of capital it needs. The question of how do you align your capital with the use of that capital is a very important thing. And not all CEOs sort of know how to go through that thought process. So my advice is always make sure that when you are out trying to raise capital for your business, ensure that you're talking to a firm that is going to be giving you a little bit of advice, making sure that the capital that they provide you is going to be useful for your company. We have seen in the market, and I'm sure Nathan has seen it too, companies are in a hurry to raise capital. Sometimes they make a decision. Maybe it's equity. Maybe they take equity when they shouldn't. Sometimes they'll take debt that doesn't make sense for them. They can't pay it back. The terms are just too onerous. So what we always do is we make sure that the CEOs that we're talking to really understand, here's how this capital is going to work. Here's why it works for your use case. And here's how you can continue to thrive going forward. But it's really about, is it an R&D use case? Is it a sales and marketing use case like you described, Ryan? I mean, you went out and raised debt capital from Nathan at exactly the right kind of capital for you at that moment, right? But if you were earlier in your life cycle and you needed capital to develop the product to begin with, that probably would have been a better case for equity. And that's one of those things that guys like Nathan and me, we sit in our seat and we have, I think, maybe a more nuanced understanding of how the financing landscape works. And it's kind of our job to make sure that when we're helping entrepreneurs out there and we're providing capital, we're doing it in a way that's really going to make sense for their business. That's a little bit of a soapbox for me, but I can't help myself.
That's fantastic. Great opening intro. Nathan, what advice do you have for companies looking for non-dilutive capital? You're still on mute.
Yeah, I think the thing I think that when I do all the interviews with CEOs, I try and collect, and Ryan, I read all your stuff, right? And I'm constantly like collecting tactics and I'm watching like what's working. And across the 3,000 CEO interviews that I've done, you sort of see folks repeating the same 30 to sort of 40 growth tactics that are sort of, they always work, and you just have to put a different flavor on them. And I think like the best model for this, I'll draw it really quick for you guys, but the best model for this is to think of it like a grid like this, right? And then what you want to do is, if this grid is representing like all the potential ways that you can grow, over here are all of your fast ways, like over here are all of your slow ways, and then up here is all your cheap stuff to run, right? It doesn't cost a lot of money. And down here is expensive. And so like what happened is, like up here, you might have things like a newsletter, right? And over here, you might, something that's going to be slower to grow, but it's going to be, cheap or relatively cheap. You might have like programmatic SEO, right? It's going to be slower, but it's still cheap. And then down here, like you have really expensive, slow stuff, and then sort of fast stuff, but it's expensive, right? So these are the 4 quadrants. And I see the biggest mistake I see people make is, if you're a bootstrapped company and you're like $1 million of revenue, you need stuff to work fast and you don't have a lot of money. You need like a quick payback period. You need cheap. So you really should only be thinking about things in this sector in terms of growth. These are going to be things like cold outreach, newsletters, compare pages for SEO, powered by buttons, virality, webinars, account-based marketing, like you mentioned that you did. Only after you break like $1 million or so of revenue do you want to go experiment with slower growth tactics, but still try and keep them cheap to preserve cash. And this is going to be things like programmatic SEO, affiliates, building founder brand, positioning yourself in app exchanges, blog content, etc. And so I think to answer your question, just like sum it all up in one thing is, you have all these tactics that you can like put on this grid, but the key that folks should think about, and I just realized I'm zoomed in a little bit here. Let me zoom out, right? The key that folks should think about is like how you move through this, right? So you want to start up here, move this way, then this way, then this way, and only do the slow, expensive stuff once you have some scale. So that's generally, like when I talk to founders, that's generally how I help them or try to help them think about growth.
Okay, wonderful. Well, I'm going to ask you guys a couple specific questions about RBF here, and then we'll open up in about 10 minutes to audience questions. For those of you watching live, you've already got some questions coming in the Q&A section and the chat window. We'll start going through those in just about 10 minutes, so keep putting them in here. Let me ask you guys just some questions. So we've already talked about what is revenue-based financing. We've already talked about how to use revenue-based financing to fuel ARR growth, take on some capital, put it into the effective marketing channels that are working. We often talk about, as Nathan said, ABM marketing for B2B SaaS companies, matched audience ads, retargeting ads, outbound on LinkedIn and email. We'll talk a lot about that. But in terms of, how do you decide, like, let's just say you are qualified for venture capital. Let's say you're growing at 100% a year. Maybe you're at 1 to 2 million in revenue. You have product market fit. How do you make that distinction between, do you go raise a Series A or do you go do RBF and continue down the bootstrapping? Keith, I'd love your thoughts on that first.
Yeah, I think that's very much an individual decision. There are founders out there who really want to take on venture money, and they want to have that experience of a lot of pressure. And they want to bring on an institutional board. They want to bring on institutional VC money. But at the end of the day, I think it's really just a personal choice. And the choice to make is, what exactly are you trying to build? Do you want to build a company that you get to own and that you get to control and that you don't have to answer to anyone for? Then maybe continuing the bootstrapping journey and adding some RBF into the mix is the right thing for you. If you want to take on a large injection of capital and really accelerate growth, because remember, with RBF and other kinds of debt financing, there is a limit. There's a limit to the amount of capital that you're going to be able to get. And it usually is that 50% of existing ARR. Or trailing 12 revenue. If you want to raise more than that, you're probably gonna want to go down the equity route. But what we always talk about with founders is, what are you trying to build? Do you want to build a company that is always yours, and you are in full control of, and for which you never answer to anyone? In that case, try to avoid equity for as long as you can. But if you want that opportunity to raise, millions and millions of dollars, and experience dilution and experience the potential to really grow extraordinarily fast for the longer term, go ahead and do that. But you have to understand the risks on both sides too, right? The risk with debt or revenue-based financing is, at the end of the day, you got to pay it back. That's the bummer about revenue-based financing. The bummer about equity financing is the pressure to grow is very, very real, and it doesn't go away. And if you do not grow at the pace that your VCs want you to grow, well, then maybe you're going to end up left in the cold when you need more capital, because those funders do sour on companies that don't grow fast enough for their portfolio. So there's a very long and winding road to, I think it depends on what exactly it is that you want to build.
And Nathan, you have a pretty advanced analytics platform that helps you decide whether to approve a loan and underwrite it or not. What do RBF lenders look for when evaluating SaaS businesses for financing?
Yeah, well, Ryan, first off, again, all this, we keep the data obviously on the platform extremely tight. It's like bank level encryption. But Ryan, do I have permission to share your account just here on your webinar with your audience?
Yeah, feel free.
Okay. So if you guys take a peek over here and we go into Ryan's SaaSRise account, right? So what you're seeing here, if I go to his analytics, right, you're seeing that full growth rate over here. So one of the things that we like to do, Ryan, when we go in here is we like to turn off starting. And what this allows us to do is see the new and if it's making up the churn. Now, some of your deals are a little bit chunkier, right? So you're going to see a little bit of variability here, but overall, as we talked about earlier, the trend is really incredible. But what this effectively is your quick ratio, right? It's all your new and reactivated and expanded revenue, right? And does it more than make up? So is it greater than one, all your churned and contracted? That's a quick ratio, right? So that's one thing that we look at. The other thing we like to look at, and we're still, by the way, Ryan's been great in terms of providing feedback to our platform. So we're still perfecting a lot of this stuff in terms of terminology, but we're also going to look at all the types of churn, right? So we'll look at both logo churn, but what I like to look at and what our underwriting team looks like actually is the revenue, the dollar value. If I switch this from percent to raw, and I zoom in a bit just for you guys so you can see this, what this is showing is in January, or even into February, so far, but let's do January, it's a full month. It's basically saying Ryan and SaaSRise signed up 56 new users, representing about $161,000 of new annual recurring revenue. And into month 2, there's still 156,000 of them paying actively, which is great. I mean, these retention cohorts for a membership like community are really, really good. We've seen some other membership type sites that just don't even come near this, right? They've got like red bars in month 2. And so we're looking at that, right? Quick ratios, churn. We're looking at some of the things that you connect, right? So you automatically populate your dashboard with your Stripe connection, the manual upload. We then verify that money is hitting your account via your bank connection. And then ultimately, like you described earlier, we'll ask for things that we can't get via API, like your cap table or articles in the data room. And once we have that full picture, Ryan, we're putting together that credit score for a business here, right? So MRR growth, retention metrics, and that ultimately determines for you, like this has grown, Ryan. I remember when we first chatted, there was only like 200, 300,000 available, but since you've grown, your offer is automatically updating. And so if you guys read Ryan's stuff, like he really knows where he spends money. So if he wanted to come in here and pull 500 grand, he could type in 500K. And Ryan, this is like the magic question, right? If I was on with you, and you don't need to know this, right? I learned everything I know about SaaS from you back in those early days. But if I was, right, I'd say, Ryan, could you take 500K today and add more than 24K of MRR? Because if the answer is yes to that, it's pure arbitrage. You're growing your revenue enough to pay for the cost of capital, which means all the extra revenue you add as that drives up your valuation, Ryan as 100% or whatever he owns of SaaSRise as the equity owner, that all accrues to you. So that's a little bit about how we think about the whole platform.
That was super helpful. Anything you want to add, Keith, in terms of how you evaluate whether to approve a loan or not?
Yeah, no, it's actually pretty darn similar. So when we have what we do is we have our customers sign up on our platform. We're taking we take the accounting and banking data, run similar analytics. We have a similar dashboard that I think you showed a few minutes ago. And then using that data, we're able to pretty quickly determine through our credit models, what is a business qualified for? And then as a customer lives on our platform, as they grow, we can start to provide more and more capital based on their revenue and expense metrics. But I think that's the really interesting thing about this market is, for years and years and years, SaaS founders had a couple of options, right? It's just VCs and maybe your bank if you're lucky enough to talk to a banker who understands and isn't afraid of software. But now we've got options like what Nathan is building and what we're building, where SaaS CEOs can come to us and a couple of others in the market and very quickly figure out, hey, I've got options here that let me build my business the way that I want to build my business. And to me, that's super exciting. But I think the way that Nathan described the key metrics that he's looking at, we're looking at the exact same things.
Nathan, do you have any different types of capital available, maybe based on the amount that are coming in, or is it all revenue-based financing? Could you delineate a little bit, if someone's coming in with $100,000 loan versus a $2 million loan, what options do they have?
Yeah, if you guys are coming in, and I'm curious to get Keith's perspective, because I'm fairly certain he also offers both an RPA product and a term loan product. And Keith, like generally the feedback we give folks when they come on our pipeline is, term loans are more work. Yes, it's cheaper capital because we as the lender have more protection, but like you're going to get into like a 9-page term sheet and a 50-page CSA. right? That's a lot more work versus like Ryan, you remember our RPA we did together? It's like a quick, like 4 or 5 page thing. You sign via DocuSign, you're done. So what we tell people is the term loans don't really make sense until you're above like 2 or 3 million bucks of revenue. If you're coming in before that, I would highly recommend for speed and simplicity's sake and keeping legal costs low to go down the revenue-based financing route. Keith, would you disagree with me on any of that?
No, I agree. There's a couple things. Revenue-based financing can mean a couple of different things to different people. So Nathan, when you say revenue-based financing and RPA, what's just like the high-level structure? Is it a gross cash receipts percentage of on a monthly basis or something like that?
Yeah, we're not taking like what we were just in Ryan's account here. We are like he's taking 500K, and to make it clear, you guys can see my screen, right? Yeah, he's then paying back 24 grand a month, but this isn't like 30% of his MR of his monthly receipts, like what Stripe would do, right? And it's a long payback period. Like if this duration, if Ryan's business was weaker, which it's not as very strong, maybe the duration we're offering is only 12 months, which means these monthly payments would be higher, or the discount rate would be quote more expensive.
Yeah. Yeah, we do something similar. Most of the time we're providing a 2 to 3 year term on the loans that we're providing, and we try to keep it super simple. So we've kind of built a hybrid product where instead of it being specifically revenue-based financing, where there's a percentage of gross cash receipts, that's the payment calculation. We have you set up on a level payment in year 1, slightly more in year 2, slightly more in year 3. It just makes it super easy for the company to understand. Here's what I'm going to pay over the course of the loan, and here's how I can think about it. Because what we found was the traditional RBF revenue-based financing product it makes it a little bit more difficult to actually do cash flow planning for companies that are kind of under that $5 million range, that just don't have that kind of infrastructure built yet. So we've tried to simplify the product to make it super easy for CEOs to use.
I want to go into some of the audience questions here. So we've got some good ones already. Feel free to post if you're watching this live in the chat window, and we'll start answering questions here. I'm just going to read these questions out loud and let either of you, Keith or Nathan, answer them or both. So one question from Lamont: can RBF be treated like a credit line where I use it for acquisitions for growth? I assume they mean external acquisitions of companies like buying and through M&A. Lamont's saying his last acquisition, he took money based on EBITDA, but he wants to do a bigger acquisition. So can RBF or what you guys do be used for M&A?
Yeah, I'll start. Yeah, I'll start. So we typically do not provide capital in that case. We really like to be able to see that the company's machine, they know what they put $1 in the machine, they know they're going to get 5 or 10 or 20 or $25 out. Acquisitions are a different kind of risk that frankly we're not super well suited to underwrite and understand. So we try to stay in our lane and say, look, if you've got a machine, then you know how to run it and you know what you're building, then that's very easy for us to fund, but we don't do acquisitions.
And what type of geographies do you guys focus on? Do you do US only, or I'll start with you, Keith. What geographies do you look at?
Yeah, US only.
Okay, and Nathan, I think you do outside of US. Tell us about that.
Yeah, US, Canada, South America, UK, the country of Jersey, because it's English common law. The only countries we really don't touch, it's really hard for us to perfect our position in Germany and France. So we generally avoid Germany and France. Obviously avoid the North Koreas of the world. But generally speaking, if we can find a way to perfect our position in a state, we just started doing deals in Israel because they have what's called an ISR, and you can publicly post your filing on that public website. So as long as we have local counsel where we can perfect our position, basically tell the world, hey, Ryan and I did a deal together, then we'll do a deal there. And so that's how that works. In terms of locations. Could I comment, Ryan, quickly on the delayed draw concept Lamont was asking about?
Yeah. Absolutely.
So Lamont, was a really good question. A good example of this, I'm gonna go down here to Steve actually, right? And Steve's actually in the chat. Ryan, I don't know, but Steve found you early, right? I think he's a paying member of SaaSRise.
Yes.
Yeah, we love Steve, right? Great company. I'm sharing this with his permission, but we did a deal with him in the amount of $4.2 million, And you can see when we recorded this quick testimonial together, maybe if I zoom in here, you guys can actually see the terms, but these were the terms, right? And again, I'm sharing this with Steve's permission. So 6.5 million of revenue. And Lamont, this answers your question, I hope, which is basically, can we get like a delayed draw where you take 2.8 million at start, you know you can draw more if you go find an acquisition you want to do, and you don't have to go through a whole nother underwriting process. And so we do a lot of these, right? $2, $3, $4 million delayed draw term loans. So you lock in your cost of capital, you know what you have, and then go do the acquisitions and the roll-up strategy that you want to go pursue. So we are doing that, and we do offer that product.
A couple other questions that came in. Great response there. That's helpful to know about these term loans that provide a little bit more customized terms for larger companies. There was a question from Munib that says, how does the rate of revenue growth impact funding decisions? You know, are you going to say no to a company because they're only growing at 20% a year versus 80% a year? How does revenue growth impact funding decisions?
We will say no to companies growing 200, 300% year over year, because we don't think it's sustainable, and they probably have a bloated cost structure to keep up that pace. It's ironic. A VC would love that.
Yep.
We love a company. And look, this is a compliment. We love cockroach SaaS companies. They've been just growing steadily, predictable, 5% year over year for 4 or 5 years. That's like a beautiful partner for FounderPath. So we see more risk if a company is growing at crazy rates, especially if it's fueled by an unsustainable growth channel.
Yeah, exactly the same. And it's an interesting question because, you know, if you're growing faster, we look at it like we can give you a little bit more capital, but there is a point where you're growing so fast that it's just not sustainable. So now all of a sudden we get less interested. So there's a point where it's just like Nathan said, it's not sustainable. So that makes us a little bit nervous.
That makes total sense. Well, a couple questions here in the chat window. So they've come on here from Andy Najar. How does revenue-based financing work for new companies? You know, let's just say you've got I assume by, feel free to clarify, Andy, in the chat, but I assume by a new company or new venture, you mean a company that's like less than a year old, maybe hasn't filed its taxes yet. You know, is there a certain length of, you know, time that it takes for you to say yes, or is just a connection to their billing system and Stripe enough to demonstrate that they have recurring revenue coming in?
Yeah. So we like to see 2 years in business and a minimum of 350K in revenue. That's kind of the point where we generally start to believe that there is repetitive and recurring revenue that we can get comfortable with, and that we can actually put together a loan against.
Nothing to add there. We're very similar.
Yeah. Couple questions here, and then Steve Benson, if you're there, I might bring you on in a couple minutes to share your experience doing 10 million of ARR. So be ready for that possibility. So Kamran Nasser asks, what's the actual cost of capital? So to the extent that you can share, you know, what is your cost of capital that you charge to the people that you're lending money to?
Keith, this is where we hold hands and we say, okay, it's Ryan's group. He creates a safe space for us and we just share, right? That's what happens.
That's right.
Now, I think.
That's
go
right.
ahead, you
That's
first.
Right.
I'll jump in right after you.
Yeah. All right, I will go first because I'm courageous. So it's totally risk-based pricing. So, you know, I said the minimum for us to be eligible for capital from Novel is 350K in revenue. That's probably going to be slightly more expensive capital than a company that has 20 million in recurring revenue, right? So typically what we see is on our risk-based pricing grid, the cost of capital can be anywhere from 17 to 22%. And it just totally depends on revenue level, growth level, expense structure, and how we're gauging that risk.
On our side, our revenue-based product facility is generally with earlier stage companies, but it's also quicker and we have less protections. So to get paid for that extra risk, it's usually a more expensive effective interest rate if you do the math and calculate the effective rate. That effective rate for us is typically going to be between 19 and 23%, very, very close to what Keith just mentioned. Now, if you look at our term loan product, like Steve can maybe talk about this. Steve, you've already shared me. We did a deal with Steve at 17% headline interest rate, right? So our lowest interest rates we offer to like our best companies. These are 10 million ARR, really strong financials and history. We can get down as low as about 16%, but we won't go too far under that. At that point, there's a lot of other options like, the publicly traded BDCs, Ares, Gold, Blue Owl, these kinds of companies that you should go work with.
Yeah, and there are certainly ways if you're a profitable company and you have 5-10 million in ARR and a significant track record, you can then access bank capital at lower interest rates. What we're talking about here is sort of what do you do in the middle when maybe you're only 2 years old, maybe you don't have a couple of years of history. How do you get that capital to grow that you need? Steve, I wanted to bring you on. Steve's a member of SaaSRise. Steve has also taken some capital from FounderPath and other firms. Steve, what have you learned about RBF and any tips for the people listening today?
Yeah, I mean, I've been doing this for years. So I guess there's a bunch of things to think about. I guess some of the ones that jump to the top of my mind are how fast can you do something? Like if you some debt providers take a long time, and the longest would be like a bank, which can take it feels like forever, but there are banks that I've been talking with for 4 years, but the speed is definitely a piece. How easy they are to, I guess I would slash that with how easy are they to do business with? Like some people are just easier. Cost, obviously, some are more expensive than others, and so you want to take that into account and get offers and see what is the best deal all in. Size has always been critical for me. Like, so, some lenders will give you a lot less than another lender. And a lot of that I think has to do with their risk profiles and how confident they are in your company. And some people will look at your company and be like, yeah, I'll give them 7 times MRR, and others will look at you and be like, I'll give you 2.5 times MRR. And so there is a big range there, and then there's a big range in different contracts terms. So Ryan mentioned covenants, and so if you go to a bank, you get very restrictive covenants, and just different lenders will have different things that are important to them, and different ways they kind of control their risk, and some are going to be a better fit for you than others, right? So things like some would have like a really high liquidity covenant, right? So I've gotten an offer for a $500,000 loan. This is probably like 2018, a $500,000 loan, but I had to always keep $500,000 in the bank. So that wasn't really helpful to me, because I'm like, well, then I can't spend the money because I don't have very much in the bank. So I'd just be holding your loan in the bank. But I think most have some level that they want you to keep around for a rainy day. But what's the ratio and how high is it? Can you get out of the loan? Early payback penalties. Some are very punitive. Others will let you out and let you refinance, which there's a chance a bank will give you a very cheap loan in the future, depending on your size. I think my understanding is that that's not really a thing until you're at 10 million or so, but I don't know. I haven't gotten there yet, so they've never made me an offer. And then warrants are a big thing. There is cheaper money if you'll give them between 0.5 and 2% of the business in equity, and that's all a warrant is really. It's a form of equity. Duration is a thing that I think about a lot with loans. Like, there's a lot of lenders that are like, here's a 6-month loan, or here's a year-long loan. That's really to cover a capital crunch. That's not to make an investment. And so, because you can't make an investment and get paid back that fast, unless of course you just literally can't afford Google ads, and you have Google ads that you've tested and will pay back, but you literally just don't have the 20 grand. Then yeah, a 20 grand loan would help you make those first Google ads, which will pay back, and then go on. But assuming you're not in that situation, you need enough time to get the money. Like, someone gives you $1 million, and you have to take that $1 million and buy the people, or the marketing, or whatever it is you're buying, that will then pay back. And to Nate's point, will it pay back will you get more MRR growth to cover the loan? Will you get the MRR growth to cover the loan before you have to pay it back? So that's really important, I think. And the interest only is another thing. Some companies will do, you got to start paying the loan back right away, and others will give you a while where you're only paying the interest on the loan. And that really just makes the loan a little bigger in effect, to have a long interest only period.
Yeah.
Yeah, I've gotten loans from Lighter Capital, from ScaleWorks, which and then Nate at FounderPath. I currently have FounderPath as my debt provider, as he mentioned.
Hey,
One one
thanks
other
for
thought.
jumping on. Did you have one more final thought, Steve?
Yeah, one last thought. If you're considering, if you can raise debt or equity, we were talking about that earlier, and I was like, "Ooh, I want to talk." This is so much cheaper than equity if you have a successful business. So you want to bring in debt and skip around. If you could do either, if someone was like, "Hey, we'll give you $2 million in debt," and you could alternatively go raise a round of VC, just take the debt and then raise the VC later at a higher valuation once your revenue's gone up, et cetera. Or if you grow fast enough, maybe you can skip the VC altogether. But it gives you, it maybe lets you skip around, which enables you to ultimately keep so much more of your equity.
Yeah, it sounds like you've been able to maintain a significantly higher portion of your equity at Badger because of utilizing RBF.
Absolutely.
All right. Well, thanks for coming on, Steve. I appreciate it. We got one more question here from the audience. Ewan from Emissary says, how do you approach balance sheet requirements and other terms that could have a meaningful impact on the attractiveness of RBF as an option? How frequently do you re-underwrite the available line? Any desire to answer that one first, Keith or Nathan?
Yeah. Balance sheet requirements, I think Steve actually touched on this. It's sort of it's a joke when you get an offer of capital from somebody, but a significant portion of it needs to stay in the bank, right? That's not helpful to you. So what we do is we don't have a minimum cash requirement. Our covenants in our deals are pretty light. We want to, when we provide capital, we want you to be able to use it to grow the business. We don't want it to be sitting there just to make us feel better. We go through some work to make sure that we're comfortable with loaning a company money, and we want them to go use it. And then over the course of our draw period, which is 12 months, we're consistently re-underwriting the business to see if maybe we can provide more capital. So the way that we'll do it is we'll say make a $2 million commitment, and the company can draw all of it on day one. They can draw all of it on day 364. They can draw it in 12 increments. They can draw it however they like. And then each of those draws actually kicks off a 2-year or a 3-year amortization, which really allows the company to manage their own cost of capital very, very carefully and very granularly. We are underwriting at each of those requests, but it's a 4 to 8 hour deal. You request, we run it through the model, and then we provide the wire. When we do that underwriting, it may very well be that we're saying, hey, we can actually provide you another $1 million as well. So here's your draw. Do you want another $1 million? If so, let's make that commitment too. So the re-underwriting is really consistently going on all the time.
Any thing we haven't covered yet, Nathan, that you think we should cover today?
I just think, I mean, Steve might kill me for showing like his valuation, but everyone nailed it here, which is like, if you can grow on debt and keep your equity, the valuation just accrues directly to you. So like, Ryan, you've already given me permission. So like, I'll show in your account here, guys, if you guys go into your FounderPath account and click over here on valuation, we'll actually show you your valuation here growing. And you can see Ryan's like this teal line, right? It's gone from, 13 million in August 2024 up to like more than doubled up to 38 million up here, right? Because of that revenue growth. But this is also tied. This is kind of cool. It's sort of like, it's like free version of PitchBook. When you have a FounderPath account, we have over 1,300 deals here of other companies like Sierra, right? Or like GiveX with $618,000 of revenue. They got bought out for $1.4 million, a 2x multiplier, right? And then how much, whatever they sold for. Or this company down here, Armis, sold 5%. And so what we like to look at is like, companies effectively come to FounderPath to skip their seed, pre-seed, seed, and sometimes Series A. So like a company like Alvis, right? They're selling 15-20% in their Series A. If you can grow your valuation and use debt to fund that growth instead of the equity, all that extra equity growth just accrues directly, in this case, to Ryan Allis, or in this, whoever's listening, the founder. So we like to show that valuation data in the back end as well.
Yeah, anything, Keith, that we haven't covered that you'd like to add before we finish up?
I don't think so. I think we've covered everything from my point of view. Any other questions out there?
Well, we've gotten to all the questions. I'll just comment on, the trap of venture capital. So the benefit of venture capital is if you have a high growth company where it's incredibly disruptive, where your market is changing very quickly, where 3 years from now, if you don't make big investments now, things are going to change. Well, then you might consider venture capital if the growth's over 100% and you need to make significant investments to win in a marketplace. That's what we did at iContact. We became the second largest email marketing company in the world targeted at small businesses. We sold in 2012, and then Constant Contact was the only one bigger than us. And then later on, MailChimp caught up and beat us after we'd sold. And so that capital was used well. We had a good exit. After selling iContact, I was able to, after taxes, make about 15 million. But that's in 10 years of my life, and I think there are other ways. If you want to go make 15 or 20 million, or even more, I think there's other ways to do it through building a successful cash flowing, bootstrapping business. And I have a nice hat collection here, and one of my favorite hats that I wear is a hat that just says I love EBITDA. And so at the end of the day, if you can generate positive growth using capital that's non-dilutive and keep 70-80% of your business owned by you, I think that's the way to do it as an entrepreneur, and certainly not dilute all your team at the same time. So keep in mind, even the 1% that raise venture capital, only about 25% of the companies that ever have a successful exit. And so congrats to those that can do it. But for the 90% of companies out there, options like RBF are a better way to grow. And thank you, Nathan and Keith, for being innovators in the space. We appreciate you so much. Check out Novel, check out FounderPath. And if anyone has any questions, feel free to reach out via email to Nathan or Keith. Any final words, Nathan or Keith, before we end up?
Just thanks a lot for having me. This was a lot of fun. I hope all of you founders out there found this useful, and keep building.
And Ryan, on my side, just remember, guys, everyone, listen, we are the silent majority. For every one that raises, there's 1,000 that don't. There's more of us than them, right? This is the less risky way to build a meaningful life, meaningful cash flow, meaningful bank, meaningful savings with customers you love, with people you enjoy. So Ryan, we need more folks promoting these kinds of stories. So thank you so much for what you're doing and putting into the world.
Well, wonderful. Thank you all for being here. We had 22 companies live on the call today, and then we're about to send this out to our email list to 300,000. So we'll have quite a few thousand extra people watching the recording of this. Thank you all for being part of the SaaSRise community. We'll see you next time. Have a great afternoon. Bye, everyone. Cheers.